This one's super practical. What does the one big beautiful bill mean for MSPs? I'm going to speak to Andrew Jordan. He's a CPA and does consulting for IT services and MSPs on exactly what it means. We get into specifics about what the bill means for your business on this bonus episode of The Business of Tech. When chaos hits, will your system survive? Comet Backup's full image backups protect your entire system, files, apps, settings, and even the OS in one powerful automated backup. Comet is easy to deploy and bandwidth efficient. Full system backups for Windows, for Linux, for servers, for endpoints, all in one centralized platform. Whether you get hit with ransomware, hardware failure, or accidental deletion, Comet restores your system to physical, VM, or the cloud. Short on time? Restore individual files or folders to access critical data within moments. Try Comet Backup today. Reliable, secure, and made to scale. Visit cometbackup.com to protect what matters most. Get $100 free credit when you sign up with the promo code MSP Radio. Comet Backup. Backup fast. Restore easy. Now, I'm interested to talk to you because you really wanted to dive into some of the tax code changes that you think are reshaping the way MSPs go to market. The big, beautiful bill passed Congress, made a bunch of changes. Walk me through how the new legislation touches across areas that MSPs care about.
Yeah, so it did a couple things. It introduced a few new things and made some tweaks, but some of those little tweaks can have pretty big impact. And then the other thing is it made permanent some of the things from Trump's first big tax law change. And so those are both pretty important, have some big ramifications for MSPs.
Okay, let's say a little more. Go a little deeper into what those ramifications are.
Yeah. Let me give you a couple examples. So bonus depreciation. Bonus depreciation was from the first Trump tax law changes, but it ramped down and it was in the process of ramping down. Well, now it's back up to 100%, which means if you buy new servers, new trucks, any of those kind of things, you can typically write off the whole thing for your taxes in the year that you put it in service.
Okay, gotcha. So that's one of those areas where it thinks a lot about the kinds of things that you purchase. I also understand that there's some stuff around the QSBS expansion and exit strategy. Tell me a little bit more about the changes there.
Yeah, it's a really interesting one because a lot of people haven't even heard of this, but it's designed for small businesses. Now, small businesses are like 10, 15 million businesses. So it's still pretty good size. If you are a certain kind of company and there's some hoops to jump through, you have to be a C corporation, some other things, but you could potentially sell your stock in your company and have zero taxes on it, which is huge because, you think about selling your company someday and I'm going to sell for $5 million. Well, that's maybe $3 million after taxes. So it takes a big haircut off of it, but you could sell it for $5 million and keep $5 million if you plan ahead and potentially jump through some of these hoops.
Okay, walk me through some of the planning. Like, what are there particular ownership structures and exit timelines I need to think about?
Yeah, so one of the biggest ones is you have to be a C corporation. Now, a C corporation is not what we typically see managed service providers operating as. A lot of times they're S corporations, and S corporations can be really good while you're operating because it can save you on taxes in certain ways. C corporations have double taxation, so there's some things to be aware of, but if you're thinking you're in a 3 to 5 year horizon for selling your company, it's at least worth running the numbers to see, man, if I switch to C corporation, I might pay a little bit more in tax the next couple of years, but then I could sell it and have a whole bunch less in tax. Again, there's a whole bunch of things you need to consider with this, but it can be, a multi-million-dollar difference for the right people.
Okay, knowing there's a lot to consider.
Yeah.
Give me a little bit of the kind of like top 3 factors that you need to consider in that conversion.
So one of the big things is when people buy companies, they typically don't actually buy the entity. They typically buy the assets, the name, everything in place. In order to qualify for this, you have to have someone who's willing to buy your actual stock in your C corporation. And again, not everyone is. So you might do all this and it could be for naught if the potential buyer is unwilling to. It's a difference we see in terms of the risk that they take on. People don't necessarily want to buy your entity because then if you have bodies buried somewhere, they take on that risk. There's ways to mitigate it. There's ways to work with lawyers to, mitigate that risk in other ways. And if it's a multi-million-dollar deal for you, you can probably find a way to make it work, but it is one of those things to consider. Have to sell the stock. Yeah.
Gotcha. Now, this probably relates to the changes to make Section 199A permanent, right? That influences thinking about pass through and C Corp. Like, talk me through what making that section permanent really means.
Yeah. So C corporations, one of the things that happened in the first Trump administration is they lowered the tax rate for C corporations. C corporations, you pay tax twice, once at the C corporation level, and then whenever you take money out as dividends, you pay dividend tax on it as though you had, Walmart stock, Walmart paid you dividend, you pay tax the second time. So they were disadvantaged. So the tax rate was lowered though in the first administration, but then that made C corporations almost too desirable. Everyone would have switched to C corporations because the rate got so low. So they added this new thing for flow throughs, and it's for S corporations and for partnerships that you get basically an up to 20% deduction. Again, depends on certain calculations and things, but to level the playing field basically. And one of the crazy things about this, and not to be political toward any party, but like, man, our government makes tax changes and both sides do this that has some like crazy cliffs. So this was here a major impact, and then it was going to completely go away. And so the one big beautiful bill made it permanent. So you can at least plan it's going to be here.
Oh, gotcha. Okay. So that makes some sense. Now, you also mentioned the R&D changes. I feel like there's a little bit more to explore there, because not only is this going forward, but you can also amend past returns, right? Walk me through like a practical example of what qualifies as R&D and how you go after, that refund opportunity.
Yeah. So what's interesting about this is R&D, people think of this as like, if I'm researching a new drug or I'm developing a brand new thing, like hard science research is what people typically think of. But the actual definitions of it are so much broader. So it can be things like potentially if you're configuring a new way of setting up a server room, potentially the research that goes into configuring this could potentially qualify. If you are developing a website, if you're doing any number of things that you think is just a tiny bit different than maybe anyone's ever done it before, that can potentially qualify for R&D credit. So certainly if you're developing software internally, if you are doing, but it's a much broader stroke than a lot of people think. And I think most managed service providers engage in R&D activity, at least at some level. So the question becomes, is the juice worth the squeeze? Is it worth the record keeping, the compliance, the filling out the forms based on how much you're actually spending?
We'll be right back after this message. This episode is brought to you by Control Map. Growing MSPs are using Control Map to build recurring revenue by expanding their GRC services. Starting now, Control Map is offering a free plan for MSPs looking to get started with providing compliance as a service. Create a free account and run an assessment. Track key items like policies, risks, and evidence in one place. It's a practical way to prove value to a client before deciding to expand your compliance offering. Try Control Map for free today. Visit scalepad.com/Dave to get started. That's scalepad.com/Dave. And we're back. Okay, let's dive into kind of an example. A lot of MSPs work on automation, right? So if they're deploying scripts or like using the kinds of tools to do RMM automation. Walk me through like a loose example of how I might consider my investment in some automation, whether or not it makes sense or not to look at this.
Yeah. And so what you're looking at is labor cost primarily when you're doing R&D, right? So it has to be people in the US. You typically cannot use like overseas contractors doing it. But if you have people in the US doing it, including your own time, so like let's say you pay yourself $100,000 a year and you say, man, I'm using a third of my time. You got to keep records for all this. And so it can be fractional time too, and my network engineer, well, we use 20% of his time for 6 months, keep all the records and then put dollar amounts to that. That's the amount you spend on R&D. And so whatever you're building, whatever you're designing, and it can be for your own internal use or could potentially be for client as well.
Gotcha. Now, knowing you're not going to give me specific tax advice, but there's got to be some sense of threshold. Like I suspect if I only work on an automation that say is 5 or 10 hours, that's probably not worth my time. You can give me a sense of like how I should think of the scope of this? Do I need to measure in tens of hours, hundreds of hours? Like, how do I think about that?
It's a great question. If you're spending under $10,000, I'd say it's not even worth looking at. You start spending 30, 40, 50, certainly $100,000, which is easier to do again than you think. A lot of times because you can count these sort of fractional time spent. man, if you're spending $100,000, it's at least worth having a conversation and putting pen to paper. And it might not apply now, but it might, and it might be next year it applies. So it's something to be aware of and actually apply to your individual situation, I would say.
It certainly would be an argument for tracking all your time to know where your time is going.
Potentially
So, and speaking of time, one of the things in looking at this was I knew that the overtime deduction might make sense too. That you noted that the new overtime deduction might apply in some limited MSP cases. Clarify that a little bit. Like, where might it realistically come into play?
So, and one of the things that we have also seen in the political arena is the Congress will pass bills and they will let the IRS sort of figure out the details. And so we have passed this and it got a lot of press, overtime, but it doesn't actually apply to all overtime. So they're sort of still hashing out exactly what qualifies, what roles, what companies, what industries, potentially they're talking about limiting a bunch of different ways. But we should see how it shakes down, because if you are paying your people overtime, and I know a lot of managed service providers end up paying overtime at some level, it can be that overtime is exempt from taxes, which benefits your employee, but can also benefit you, because then you're potentially not paying those payroll taxes on those dollars. Again, depends on exactly how they end up figuring this when all the dust settles, but could be some significant dollars there.
Okay, it sounds like there's a little bit of still uncertainty. What are we waiting on to know, or how will that get shaken out to know if this makes sense?
Yeah, so the IRS is still figuring out exactly how they're going to enforce this, what the end forms are going to look like, what the actual calculations will look like in some cases, what sort of the limits will be. So it's open to a lot more interpretation by the IRS than, Congress kind of more said, this is what we want to have happen. And then the IRS is figuring out the details of how we're exactly getting there.
Gotcha. You live this world all the time. Is there a particular timeline we should be thinking about? When are we going to get clarity with that?
Surprisingly late. And the IRS has a history of dropping these kind of things without any fanfare, without any advance notice. We've seen this a lot more the last couple of years. They're certainly shorthanded right now too. So it's one of those, it's worth having on your list, check with your CPA if you think this might be something that applies with you as you get closer to year end and see.
Okay, makes sense. It was a good warning. This is good timing for that. So the other thing that I kind of wanted to think when I'm thinking about timing was, with these broader deductions and some of the changes here, are there particular changes to the way MSPs should think about financial planning as they consider getting ready for a sale? I mean, I would make an argument that most should always be thinking about putting their organization ready for sale, but some may say hey, I'm starting to think about it in the next 3 to 4 years. Are there particular differences you think they should focus on now?
So a couple things. The QSBS, that is the most direct thing, right? That thing we talked about at the beginning about, and if you want to look it up, section 1202 is kind of the code section that applies to this. So you can kind of educate yourself a little bit on it. That could be huge. Beyond that, taking accelerated depreciation, maybe a good time to clear up a quick myth. What I often hear from people is, I want to save on my taxes, but I want to be able to get a bank loan. Or I want to save on my taxes, but I want to be able to sell my company and not have it discounted. So EBITDA, right, is this acronym, earnings before interest, taxes, depreciation, amortization. What it means is if you buy those new vehicles, you buy that new server room, you fill it out and you take the accelerated depreciation on it, both for loan purposes and also for selling your business purposes, all that depreciation gets added back. So it's not one or the other. Depreciation is one of those rare have your cake and eat it too. Save a bunch potentially on your taxes and still be able to get a loan, still be able to sell your business for kind of a premium.
Gotcha. Okay. The other thing I kind of wanted to get a sense of from you on is, when I think about R&D, and if I'm starting to go through my organization and think about that, there might be some thinking that claiming R&D credits kind of invites more scrutiny. How do you mitigate that risk while still capturing those legitimate savings?
Yeah, we do encounter this sometimes. I had a business owner recently tell me, I don't deduct any meals because I just don't want to invite the scrutiny. And so this is one of those sliding scales. Make sure you're working with a tax professional who has a similar level of risk that you do, right? But if you are qualified for a deduction, there's nothing that the IRS has said. And part of this is just the IRS is so unsophisticated. You would think that they could have these red flags that trigger things and you're going to get an automatic audit. They're way less capable of that than you would think that they would be. And so it's really less about triggering red flags and trying to fly under the radar. Just claim all the things that you are enabled to claim. Make sure you have good support for it. Make sure you're not, cheating on your taxes, of course. But then as long as you're doing everything on the up and up, you have good records, like an audit's really not that scary.
Okay. You said something that I think is worth expanding upon a little bit is matching yourself to a CPA that matches your risk level. Say a little more, like how do you determine that? How do you understand what that is? Because you're right, this is a sliding scale of risk. How do you figure that out?
Yeah, I would just have that very direct conversation, because if you're someone who's wanting to be really aggressive and take risks and you're with a CPA who's super conservative, that's not great. And the opposite isn't either. So I would just have that conversation with your CPA, like, hey, what is your tolerance for risk? Like, how do you view risk? And like the way we describe it for our firm is there's a level of gray, and we will be in the light gray, things we think are very defensible, very reasonable, but we don't play in the dark gray. And some firms do. And if you're someone who's going to be pushing to play in the dark gray, like find a different firm, not good fit for us.
Gotcha. That makes a ton of sense. Andrew Jordan is a CPA and financial strategist specializing in the IT services and MSP sector. As the founder of Jordan CPA Services, he advises technology business owners on tax optimization, growth strategy, and exit readiness. He is recognized for translating complex tax code updates into actionable strategies that improve profitability and long-term valuation for MSPs. Andrew, if people are interested in getting in touch, having more conversations, what's the best way for them to do that?
Yeah, so our website is jordancpaservices.com. You can email me directly at ajordan@jordancpaservices.com, and would love to visit.
Well, awesome. Thanks for joining me today.
Yeah, thanks for having me.
Want more from the Business of Tech? Join Business of Tech Plus for ad-free episodes, early interviews, extended cuts, subscriber-only shows, and exclusive member perks and analysis. Sign up at businessof.tech/plus. And follow this show in your podcast app, and if you're on YouTube, hit subscribe and the bell so you never miss a story. Reviews and comments help spread the word too. Interested in advertising? Head to mspradio.com/engage. The Business of Tech is written and produced by me, Dave Sobel, under ethics guidelines posted at businessof.tech. Thanks for listening. I'll see you on the next episode.